There's a lot of different ways to look at a developer's pipeline and their business model that can make a big impact on how much profitability they have and how much risk they have as well.
You are listening to the Property Developer Podcast, your home for tips, ideas and inspiration to help take your developing to the next level. Now here's your host, Justin Getty.
Hello and welcome to episode 35 of the Property Developer Podcast. Thanks for joining me. How are your projects going? How are you going? I hope everything is progressing just as you want it to. I've got a great discussion coming up in this episode as we catch up with former guest and funding whisperer Dan Holden from Holden Capital for an update on the lending landscape and some tips for making your capital work harder. I don't have too much to report on what I've been up to lately, except that I've been working on putting my team together for my tribunal hearing. I pretty much have the key players in place now, and they are making their preparations for the hearing. I've also been getting in touch with some agents about potential sites that are around and what's happening in the markets. And I've been talking to potential investors about joint ventures and other kinds of projects. Okay, on to today's guest, Australia's #1 commercial finance broker, Dan Holden. It's been more than a year since we spoke with Dan, and a lot has happened across the lending landscape in that time, and also with Dan's business. So we have a lot to catch up on. During this discussion, we talk about what's happening with construction finance lending, where sources of funding are coming from, and ways that you can make your capital work harder for you. I'm sure you will enjoy this discussion, so here is Dan Holden. Dan Holden, welcome back to the Property Developer Podcast.
Thanks, Justin.
It's good to have you back.
Cheers, mate.
Now I need to start off by asking you a different question to what I would normally ask my new guests.
Yes.
So, what's the best bottle of wine or drink that you've had lately?
Good question. Probably, I'd say it's actually a Scotch, which I stumbled across probably about a year ago when I was in Japan hunting for money. And it's called Yamazaki, and it was voted world #1 Scotch in 2016. And it's pretty good. So I'd say it'd be that. And then coming back to Australia, there's only about 3 or 4 shops that stock it. So it's a bit of a discovery when you can find it, and it's pretty delicious.
All right. So now we know what bottle to buy you next time we want to impress you.
Yes, indeed. It's pretty yummy.
Oh, that's good. I was fortunate enough in a former life to spend a week in Scotland with the master blenders of Johnny Walker, learning about Scotch, and picked up a bit of a taste for it from there.
Yeah, it's particularly good during the winter months we're having at the moment. Give you a bit of warmth.
Oh, well, next time we catch up, we'll have to have a Scotch tasting session, Dan.
Sounds good. I'm in.
Now, you were a guest on the show well over a year ago, episode 14, which was a ripper of an episode. If people haven't heard that, they should go back and have a listen. And you've been pretty busy since then. You enjoyed the podcast so much, you started up one of your own.
I did, mate. I thought it was a bit of a fun experience, and I guess realised that I'm fortunate enough in my role to have contact with some pretty cool people in the property industry, and I thought it'd be a bit of fun to get them on the microphone and try and tap them for some pearls of wisdom. So I've been doing that for the last 12 months, and enjoying it, which is the main thing. I've kind of taken it on as a bit of a thing where I said if I keep enjoying it, I'll keep doing it. If it becomes a bit of a chore, then I should probably down tools and stick to what I'm good at. And I've actually really enjoyed it. So we had some pretty cool people, some top national property developers on telling us about their journey, and we've had the Lord Mayor of Brisbane. We've had Bernard Salt telling us about demographics and what makes a city and a region grow. We've covered some pretty cool topics with some cool people, so it's been fun.
And what's it called? The Constructive Finance Podcast.
Spot on, yep. So I think we've just cracked 10,000 downloads last month, which is pretty cool.
That's very good. Well, it's a really good podcast. I listen to it every episode, and I've promoted on the show, so if people aren't listening to it, they should subscribe because it is very good.
Awesome, thanks, mate.
And apart from podcasting, you've been picking up awards.
Correct, yeah. We were fortunate enough to win number one commercial broker of the year again for 2017. So we won on the inaugural year in 2015 and 2016 and got the three-peat in 2017, which is great. So we've been, I guess, pushing pretty hard the boundaries to be at the forefront of what we're doing. We've done a lot of travel overseas to help expand our lender list and find more people that are willing to lend money to property developers in Australia. With the banks tightening up, you've had to kind of innovate and push hard, and so we've been doing that quite a bit, and also obviously doing a fair bit in the education space in terms of the podcast. We've released a finance dictionary we released about 12 months ago. Every year we do a feature piece where we try and inform developers of what capital options are available to them. And so, I guess trying to push things a little bit harder. We've been recognised, which is great. That's very exciting.
Yes, for a financial institution or a finance-related business, you certainly do some very good marketing, I have to say.
Yeah, well, I mean, I think a lot of it comes from just that place of wanting to educate developers with and share the knowledge that we've got, so that when they come to us to finance a project, that they're, I guess, asking questions that we can quickly answer and help them to grow their business. So I think when you take a little bit more of a helicopter view of what we do, we actually help developers grow their business, and we do that via, helping them be sustainable with their capital, and being able to invest in more than one project at a time, and helping them grow what they're doing, as opposed to just trying to be, save them 10 points on their loan. We're trying to actually look at them at a holistic point of view. So that's with education, showing them other transactions that we've recently completed, so that they can understand what's achievable for their next project.
Yeah, so and we're going to go through that shortly, but seems like you've also opened up some other offices around the place.
Yeah, so probably about 12 months ago, we opened an office in Sydney, which is going well. We've got 2 guys on the ground there, and then next month we open an office in Melbourne full time. So we're fortunate. We've got 3 of the Brisbane guys here who are ex-Melbourne, born and bred, and so they've got a long client list, and we're already servicing Melbourne, doing a number of projects out of our Brisbane office, and so now we'll have somebody full time on the ground in Melbourne, and with the second person likely to join before Christmas, and so that'll give us Brisbane, Sydney, Melbourne, and we also late last 2016 opened an office in Hong Kong, and that was really off the back of I think I've done 7 trips to Asia in the last 18 months, 2 years, searching for capital, searching for investors, and regularly going up there to inform them about Australia and the real estate market here and how they can get involved. And so through that constant travel and trips, we decided it's actually better to have somebody full-time on the ground over there to go and attend those meetings more regularly and to go and investigate new sources of capital. So we've now got Brisbane, Sydney, Melbourne in terms of the projects that we fund, and then Hong Kong, which services Singapore as well in terms of inbound capital to help fund the projects that we fund. So bit of growth in the last couple of years.
And how are you finding the reception you were getting from potential investors or people with capital about the Australian market in general, and then I guess more specifically within that Aussie market?
So I think initially it was a little bit of reluctance, because the main question was, why aren't the banks doing it? And that was probably the first, second and third question on any transaction we'd put forward. And they really needed to see that it wasn't because of a massive market oversupply, that it was an actual regulatory, and kind of systemic thing that was happening in our banking world. And so now it's definitely easier than it was 2 years ago when I first started going over there, to get people's attention and to get them in a position where they're comfortable to write a check and get involved in financing a project. But initially there was just a lot of, no one wants to be a pioneer, and they'd much prefer to be investing in something that other people are investing in, so that they're not going to get their fingers burnt in something that, because so once they actually got the comfort that projects were still being funded, the world wasn't going to stop turning. It's now a lot better reception, and the new people we're talking to now are a lot. The journey from start to finish to them to actually writing a check is definitely a lot shorter, which is great.
And why are they more confident now?
Because I think they can see that the world is still going to keep turning. There's still projects that are happening. There's still some great success stories, across Brisbane, Sydney, and Melbourne, of projects still getting great sales rates and selling out in pretty good time. So I think that there was the hesitation that it could have been an oversupply issue, and that's why the banks weren't funding these new projects. We've seen a lot of cranes come down from, I think I call it as November 2015 was when APRA kind of put wanted to see the banks have less exposure to commercial property. And so we've now seen a lot of projects complete and repay and extinguish those loans that were out at that time. And, the world's still turning and projects are still selling well. So I think now that we've kind of gone past that, where you were holding your breath, hoping that the market didn't saturate or we had a massive market correction, we're now kind of, back to business as usual. And that's what people want is, consistency in revenues and costs in sales rates, so that they can take an accurate view of the project that they're looking at funding. So I think it's a much better place now than it was, probably 12, 15 months ago, when we had a big surge of projects that were coming through the end of the bank funding kind of era.
Yeah, well, last time we spoke, we talked about whether Apartment-geddon was going to happen, and it doesn't seem to have materialised. Why do you think that's the case?
I think what it does reflect more so is that it wasn't, the only contributing factor wasn't the market. There was the underlying APRA kind of constraints that they were putting on the big banks, and even now when the banks have got a lot of that money back, they're not running out to write big checks again, because it's a fundamental thing rather than just a market thing. But I guess in terms of Brisbane, we saw potential oversupply issues. We've seen so far that it's been absorbed well. Settlements have gone well. We've seen rental of the end product going better than expected, and Sydney just goes from strength to strength. New projects launching in Sydney that we're seeing or involved in are just selling really well, which is great. Melbourne seems to have, probably been the most recent potential casualty, and so far it hasn't. We haven't seen any major catastrophes, which is great. I think the apartment market there is, fragile and probably has been for the last 6 to 9 months. And the house and land market just seems to have gone for another surge, which is great. So I think overall there's a lot less panic now than there was 12 months ago, which is great.
And then what's the general update on lending at the moment?
Yeah, so I think probably first point to cover there is that the banks are still doing deals. There's a lot of kind of scuttlebutt that the banks are shut and they're not lending to anyone, and they're not funding new projects. I'm a bit of a defender of the banks in a sense that we do see the transactions that they are doing. Our business in the last 12 months has funded probably about 80 to 100 million of construction debt out of the major banks. So we're a bit of an advocate that they are still doing what they need to do. It's just that they're doing it in a very select manner, and they're probably, rejecting 9 out of 10 things that come across their desk because they have a restricted appetite in what they can do. But first and foremost is they are doing transactions, and we're settling, probably 1 or 2 deals a month with the banks at the moment. So they're still there, but they're still being, not overshadowed is the wrong word, but kind of managed in their appetite by APRA. APRA released an open letter to the banks about 3 months ago. It would have been about early May, and they actually said we're still wanting more housekeeping of the bank's balance sheet and exposure towards commercial property. And so that has been a long process, some 18 months since November 2015, and they're still wanting to see more, strict policy and approach to commercial property. And so as a result, like I was commenting before, we thought that once the, kind of larger bulks of capital that was deployed in 2015 was back and those cranes had come down and the projects had completed and the bank got their money back, that they might come back with a bit more of an appetite. That letter was probably timely to say no, it is a longer term requirement that the banks have less exposure to commercial property. And when I say commercial property, I don't mean office buildings and that. I mean commercial use of money to fund property, as in not a consumer loan. So there's, coded consumer loans which lend money to Murray Park Kettle to buy their house, and then there's the commercial side of the bank which lends to people to build buildings or house and land packages or townhouses, but that's what they consider a commercial transaction.
Oh, thank you. I was just about to ask you that question.
Yeah. So I think what the result of all of that is that it really puts a bit of pressure on property developers to either adopt their business model in one of two ways or potentially get a little bit hamstrung and suffer the consequences. So the two ways that a developer might be able to adopt would be the one, using a lot more capital to fund their projects. Most banks are going to want 75% of cost provided by their capital and 25% by the developer themselves, and generally speaking in cash. And there's some other ways that you can manage that with mezzanine debt or preferred equity, but in a bank's ideal world, the developer's putting in 25% of the total development cost in cash, and they're covered, majority by pre-sales. Most of the time it's 100%. Some smaller projects it's a bit less if you've got a good story why. So that's one option where you can adopt your business model, is to use a lot more cash, wait till you've got your pre-sales and then start construction of your project. The other way is to adopt your business model via either taking on smaller projects that don't require pre-sales. So for projects under, kind of 3 million or 5 million of debt exposure, if you've got a good sponsor story, you can generally get funding without pre-sales from the banks, but it's more rare than it was previously. So it's either adopting your business model via product so that you can change to do products that are less have less requirement for pre-sales, or it's to actually change the way you fund your projects. And we're seeing a lot of developers doing that over the last 18 months. And I guess looking at the actual cost of funding and looking at how it can actually have an advantage to them. So a property developer with 10 to 30 staff whose career, who make their living out of property development, when you think about it, they're actually a property trader. So they make more money the more property they trade, as opposed to collecting it and trying to keep it for 5 years to create squeeze the lemon on the return. Property developers actually want to get in and out as quickly as possible. And if you're taking the first approach, which is to put in lots of capital and take your time on the project, that's fine. We've got some clients that are doing that. It's just going to slow down your business. And when you're in property development, you've got to look at what's slowing down my business. Is it finding development sites? Is it finding the right product? Is it getting council approvals? Is it negotiating with the builder, or is it finance? And looking at any of those 5 elements and saying, how can I expedite or remove the bottleneck that I'm currently doing? So we see some developers do that. They go, right, what's my current biggest constraint to me growing my business? And it might be planning. So I've seen a few developers who have taken their whole business from New South Wales to Queensland or Melbourne because of the planning constraints in New South Wales, where, in their words, you've basically got to go to court to get an approval, or you've got to be happy to sit there and wait for 12, 18 months for the approval to come through. So that's a bottleneck in your business. And so some developers will go, right, I'd much prefer to be delivering product in Queensland where I can get an approval if it's risk smart in 7 days or if it's code accessible in 3 to 4 months. So looking at those bottlenecks, or it might be buying sites. So it got very competitive for a while there trying to buy development sites. And so you saw some developers actually change or adopt the product that they're doing so that they were able to buy development sites in less competitive markets. So an example of that at the moment, you see a lot of developers who were building residential product and now moving into commercial assets, i.e. income producing assets such as childcare centres, petrol stations, strip retail, shopping centres, and there seems to be a big shift towards these sites. And as a result, we're seeing those sites now sell for really high dollar figures that make the feasibilities basically not work. I've helped developers with finance on a few of these types of assets and also helped them bid on assets where I've looked at something before they put in their offer and we've gone, yep, here's what we should pay. And then the asset ends up selling for, an extra $600,000 or an extra $1 million. And when we put that back through our feasibility, we go, it actually didn't make much profit. But because there's such a big demand for those types of projects, so when you look at those kind of potential bottlenecks and you go, how can I manage my business so that I'm not constantly constrained by that one thing, buying sites, getting planning, or getting funding, and then you say, well, how can I adopt that? It might be changing product. It might be changing to doing smaller projects, or it might actually be doing bigger projects or something different. But it's actually adopting your business model so that you're no longer constrained by that. And I guess that you're no longer, chasing the same thing that 100 other developers are chasing in the marketplace, so that you've got something a little bit unique or doing something a little bit differently. And so we're seeing developers do that with construction funding. They're saying, how do I change my business model so that I'm no longer sitting for 2 months for a bank approval or sitting here for 4 months to get those pre-sales so I can start construction, and how does my business model look after that? And so they're looking, we're working with developers who actually take that approach and go, I want my business model to be nice and smooth, nice and consistent. If I'm making $80,000 per townhouse and I've got a business of this size, I need to be doing 80 to 100 product a year. And to do that, I can't have these bottlenecks that hold me up for, 6, 12 months to get my product in the right position at the right time, i.e. that they've got one project in due diligence, one in planning, one in marketing, and one or two under construction. One might be completing. So if you look at that and you go, right, each project is, 15 townhouses or 20 townhouses, and they've got this kind of conveyor belt of things, these projects that are coming through their pipeline. Some developers take that approach and they go, I've got my pipeline of projects, I've got my approach to business, and they then manage that so that they don't have these hiccups, i.e. getting stuck in council for 18 months on one of their projects, or being stuck in marketing waiting for that last sale to tick the bank approval. And so they look at ways that they can rework their pipeline, rework their business model, and get the best out of what they've got to work with. And so it's exciting working with those developers because they actually take that kind of larger macro view and they take it to all elements of their project, not just funding, but finding sites, working with builders, delivering the product, getting the buyers, signed up on contracts, all of those things. So there's a lot of different ways to look at a developer's pipeline and their business model that can make a big impact on how much profitability they have and how much risk they have as well.
Yes, well, the issue of getting a planning permit is certainly one that resonates with me at the moment, having to go to the planning tribunal to get a council decision reviewed. So I can fully understand how that can slow things down. Yeah,
and it's frustrating for them because they've got this nice plan at the start of how it's all going to work, and then you hit this hiccup, this bottleneck, and it's frustrating because it slows a lot of other things down.
Indeed, it does. Now, we're going to go through some of the finance options some of the key finance options that you think are available out there for various types of projects. so that people can get a bit of an idea of how they might be able to fund their project.
Yep, absolutely. So about a couple of weeks ago, we released a product guide book, which goes through, and which I think you and I spoke, we're going to try and make a link available to people listening to the podcast. And so what it does is it goes through a variety of different projects, from at the start, settling a development site. Then the next section talks about a small residential project. So small might be up to 20 townhouses. It might be as small as 5 townhouses, and how you would fund that project. Then we've got medium to large projects, which we would typically call kind of 25 to 100 or 200 product in a single project or a single stage. And then we actually go into mezzanine debt and preferred equity options, and what kind of products in the market are available currently for that. And then we talk about residual stock loans. So on completion, if you've got some product left over, how would you finance against that to either repay construction debt or release some capital? And then we've also got a section on commercial investment loans, i.e. if you own a shopping centre and office building, how that market looks, the debt market, and how competitive that market is. And so the reason that we've done this is so that if a developer is looking at a particular project, so let's say it's a medium to large residential project, we've actually got a comparison between the bank, what options are available for the bank, roughly what the pricing is, roughly what the gearing is. And then we've also compared it to some of the offshore capital that we're seeing funding projects at the moment. And so the benefit of that is that somebody can sit down and go, right, this looks kind of like my project. I'm building, 60 apartments, and here's a project that Holden Capital have recently funded, and here's what the cost of funds was, and therefore they can work that into their model. So we put that together, and it's a live document, so we will update it as the market evolves and as more capital comes into the market to fund more projects. I think even, since we released this, there's probably another 1 or 2 lenders that have entered the market, which will, not materially affect what's available, but probably just give a couple of extra options. And so hopefully that just explains to people what the options available are, i.e. settling a development site. Sometimes that can be the first challenge. What capital is available? How do I fund it? How do I structure it? We've released that and hopefully gives people some insight into what's available. What I wanted to talk about today particularly was just the difference between mezzanine debt and preferred equity. So the main criteria that I look at there is mezzanine debt is an extension of debt, i.e. if a bank's providing 75% of cost, we might top that up to 85% of cost, but it's a debt piece. It sits there secured as a mortgage, and the longer it takes, the longer it costs you to pay it back. It's a pretty simplistic kind of structure in a sense that it's just extending the debt you've got. Whereas preferred equity has a very different approach and a very different flavour in terms of that we're more contributing to the actual equity stack in the project. And so a typical approach to a preferred equity joint venture, which is talked about in page 8 of our product guide, is actually an approach where we'll actually become a partner in the project. And the way that we'll look at that in terms of the capital stack of who's contributing what is we'll provide 80% of the capital. The developer provides 20% of the capital. They run the project. It's their project. They're calling the shots whilst it's all going well. If we need to get involved, we will, but preferably they're an experienced developer who knows what they're doing, and they're running the project. And we'll share the profit 50-50. Now, a developer might say, why would I give away half my profit? But you compare that to a developer putting in all of their cash. They're then putting in 25% of their cash, and they get 100% of the profit. If you're doing an 80, 20, 50, 50, they're then putting in 5% of the cash and getting half the profit. So it's participating in a project because they've got the skill set, they've identified the project, demonstrated that the product is desirable, and it's not pioneering, it's not crazy product that they're building. They've de-risked the project to get it to a point where it's shovel ready, i.e. they've got the approvals, the permits, they've got the builder lined up on a fixed price contract, they've got a valuation that shows that they can sell the product for X dollars in the marketplace, and then they actually bring in external capital to help advance that project and also to help them grow their business. And the reason I say that is that a developer's cash is always better used for higher risk activities. So if you look at a developer's pipeline of projects, like I was saying before, they've got, one in due diligence, one in planning, one in marketing, and maybe two under construction. The developer's capital is always best used in that early phase of identifying and structuring of the deal. And its least highest and best use is towards the tail end of a project. So hence why we will sometimes get involved in a project that's actually under construction. It might be 6 months into a 12-month build, and we'll actually get involved, release that developer's equity and provide that as either a mezzanine debt or preferred equity investment into the deal, so that developer can withdraw their capital from that project to then put back into the start of the funnel, the start of the pipeline of their projects. And so the reason being is that let's say the developer had 2 million of capital in the project for a round number. So the bank might provide 6 million. The developer's got 2 million in there, being 25, 75 contribution. The developer then needs $1 million to go and do to get a early phase project up and running. So rather than us investing $1 million into that project, which has still got a lot of risk on the table, we're better off investing in the project that is very de-risked, i.e. the basement's already been dealt with, the construction's already well advanced, there's probably already some pre-sales in place. And us getting involved in that project, we might, for example, charge only 20, 25% per annum on that $1 million that we invest into that project, and limited to only that project, that developer can then withdraw and put back into the start of their project pipeline, which would then earn them a much better return than 20% per annum. And so the developer's cash should be used in that early phase, and then as the project progresses and de-risks, the developers should be looking for external capital to come in, and that frees up their cash to go and do the more higher risk, higher return activities in their pipeline. So looking back at those structures of how you do that, that would be either mezzanine debt, i.e. extending the debt in your project, or preferred equity and doing a joint venture with a capital partner that will then let you be the developer and let you do what you're good at, and then free up capital for you to go and keep your project pipeline progressing.
And what sort of period of time, Dan, would that be effective for, to use that kind of facility to pull your money out?
Generally speaking, it's from construction commencement. So us getting involved in a project which the site's just settled, they may or may not have planning approval, the cost of that capital is substantially different than if they've already got a fixed price construction contract in place. They might have sold 30% of the product in advance of starting construction. That's a substantially different risk profile for us, and the reward that we need for taking that investment will be substantially lower. And so the later stage that a developer can get external capital involved in a project, the lower the cost to them, because the lower the reward we need to justify because we're taking less risk. So to say that another way, if we're getting involved in a project, let's say it's 25 apartments, and there's only 5 months to go on construction, so our money's only going to be out there for 6 or 7 months until it gets repaid. The basement's already been done, the structure's substantially complete. We've got a good understanding of any contingencies or cost overruns that have arisen. There's probably 10 or 12 pre-sales at hand, so we can see our exit very clearly, that those sales are going to come in and refinance maybe the senior bank, and then they get a little residual stock loan to pay out our money, and then away they go. And so the visibility, the line of sight for us to see our repayment there is very simple. Whereas when we're getting involved in a project that hasn't yet launched its marketing, does or doesn't have approval, you've got an email from your builder saying it should cost roughly this, is there's a lot more risk on the table, and therefore we need to charge appropriately. And then you look at another extreme of that is trying to get external capital involved to help you pay a deposit on a site that you don't have planning, you don't have construction numbers firmed up, you don't have a valuer agreeing with the GRs that you've put in your FISO. The risk on the table there for us is huge. So it's using external capital when you've, I guess, most added value and most demonstrated your skill set of de-risking a project, which is generally later in the project, and then the cost of capital to the developer will be much lower, and the safety for us is because the safety for us is higher. Therefore, we don't have to charge as much for that money coming into the project. And so back to that pipeline, that developer's pipeline of the projects they're working on, their money should be used. Highest and best use of their money is that early phase, highest risk, highest return, and managing it through that phase of de-risking it through planning, through construction, costs being firmed through market, firming up the GRs in the project and maybe getting some pre-sales, and then bringing in external capital closer to completion where it costs them the best return on their dollar. And so to put that into some actual metrics, some actual numbers, a developer's IRR on their money should be at or above about 100%. So if you're putting money into a project and you're borrowing from the bank at 5.5% and you're putting in, let's say that example before, you're putting in $2 million and you're only getting a developer's IRR of 30% per annum, then that's great if that's your business model, and there's nothing wrong with that. But a lot of the developers that I work with, their IRR is generally speaking, triple that. It's at 100 or higher. Sometimes it's at 200 plus, because they're using their money in the higher risk phase, then they're bringing it to a shovel-ready position, and then they're bringing in external capital at a pretty low cost. Like some people might say 20% per annum sounds high, but compared to what your money should be making, you're actually then offsetting or selling down that risk to somebody else to then put that money back into the early phase of your pipeline. And so as a result, their IRR on their money is fairly high, because they're using other people's money creatively to get their project pipeline working well, but only at the right time. So, high leverage isn't great unless you've de-risked it to a point where it makes sense.
And then what about site acquisition? How are these elite developers managing to acquire the sites in that highest risk phase?
So most of them, there's actually a number of different ways. I've worked with some developers who settle a site in cash. They wait till they get the project literally shovel ready, as in with pre-sales and everything, and then they, like a vacuum, withdraw all and sometimes even more than their actual cash contribution at the start. And so they'll use pretty much, call it 90% of their bank will be just in pre-construction phase. And then and that's driving it pretty hard, right? Bringing in complete funding a project totally with external capital. But if they understand the developer's business model and they understand how capital works, they actually can drive their business that hard that they're doing a project with completely external capital. And we've funded a multiple of projects that are structured that way, because we can see that the developer has cash. He's got a good track record. He's delivered. He's de-risked the project to such a point that we're comfortable being involved in that project to that position of gearing, and we can see that he's actually withdrawing that money to go and secure the next project and get it to the same shovel-ready position. So how developers settle their site might be, they might be borrowing from a bank, but the LVR is going to be pretty low. They're going to have to demonstrate serviceability, and they're going to have to obviously jump through some hoops to get that, because most banks can, tell when it's a development site and they're not buying a 40-year-old dilapidated house because it's a good investment. And so when the banks pick that up, if it quacks like a duck and walks like a duck, it's probably a duck, and the banks generally pick that up. And so the alternative there is to use private money, which we provide on development sites, anywhere from 50 to 75% LVR. In some cases, we've actually 100% LVR on a development site because we can see that the uplift is imminent and that we can take a position on the exit, so that we're comfortable to be involved in that. There's a number of different ways that developers can settle that initial development site. Some developers end up paying more to the landowner so that they don't have to settle until it's got approval. That's fine, but it's a negotiation up front to get control of that. So we generally get involved once the developer's actually got the site, got the idea, and then comes to us and says, this is what I want to do, what options are available to me, and then we'll, based on their feasibility, we'll package up some different options to say, here's straight bank debt, here's a mixture of debt, being debt and mezz equity, that i.e. you're extending your debt further, and here's an option where we will get involved as a joint venture partner to help you deliver that project. We'll generally get involved in that early phase, and for repeat clients, we'll get involved even when they're making offers on sites, because if you're a developer going out and you're going to buy a development site for 30 apartments, it makes a big difference if you need to put in $3 million to do that or $1 million in terms of your actual cash contribution day one to get that project happening. You might look at it and go, if I've got to put in $3 million to make $3 million in 18 months' time, that's great. But if I then have to put in $1 million to make $2.2 million in 18 months' time, that might make the project more attractive or less attractive to know that you've got how much capital you've got to put in. So we're often involved in developers making offers to purchase on sites because they want to understand how much cash they've got to put into that project to get it fully funded, completed, and how much profit they're going to get back at the end.
And so building up that base of cash, is that just something that developers would do over time? They build up to have that cash at hand?
Generally speaking, it's what capital base are they working with right now, and how are they, what return are they getting on their money right now? So your money sitting in a project for the next 12 months until completion isn't the highest and best use of your capital, as I've mentioned before. And so, how could you better utilise that capital to progress your next project, to bring forward a project? You might have a project that's sitting there because it needs, $3 million to get underway, and your money's tied up in another project, and you've got to wait till that completes, titles are issued, and settlements happen for you to get your money and commence that project. So there's other ways to be able to bring projects on board earlier. But back to your question, it's looking at how much capital you've actually got in your business right now. You might have 2 projects underway or 4 projects underway. How much actual cash is in that project? So if you look at your balance sheet or business kind of model and sit down and go, how much is actually there, and how can I make sure that has the highest and best use for me as a property developer? And so that's the question to start with, and then look at strategies to actually get that earning the best return and helping you grow your business.
And so that's obviously something that you offer to your clients. What kind of developer would you be looking for as someone who would be good to work with?
So most of the clients that we work with are what I would call middle market private entrepreneurial property developers, being that they earn their income from building, developing, trading property, and that they want to grow their business. We've got some clients who are at the later stages in their life. They're not trying to grow their business. They're just trying to deliver product, and they look at their business model that they make 80, 100,000 per townhouse, and that they want to deliver 40 product a year, and that's their that's how much they want to get them through the last couple of years of their working life. They go, yep, this is what I want, and that's their business model, and that's great that they understand it. I think there's unfortunately a few people that we do meet in the early phase of working with them, and they don't know that number. They don't know how much of their own capital they've got in their business model and how hard it's working, and they don't know what their simplistic approach to their annual pipeline looks like. How many product is it? How much profit do you make per product? What are your overheads? How many staff have you got? Well, that's straight away, if you've got 8 staff, you're looking down the barrel of over $1 million a year in overheads in office costs and everything. So if you're making $80,000 per townhouse in profit, how many product do you have to do to actually make a profit and have capital to grow the business next year, so that you're actually growing rather than going backwards. So these are all questions, I guess, that most people would look at in starting a business. But I think as businesses evolve and property developers kind of grow in size, sometimes they forget to do that business model check to say what does next year look like, what do the next 3 years look like, and how much capital do we need to actually make that happen.
And I know that we've spoken in the past, and one of your suggestions around developers keeping a lid on their costs is not to hire people to try and use consultants wherever possible. But at what sort of size would you start to think about hiring staff?
I'm not sure. I mean, I've seen some pretty successful guys who run, 300 lot land estates, and they've got literally one staff member. So there isn't probably a catch-all answer for that one. But I just look at what they need to deliver that and what skill sets they need to be able to deliver the project. And when you look at your ideal business model and say, right, I want to have, 4 to 5 projects on the go at any one point, one in DD, one in planning, 2 in construction. How much capital does that require, and how many man hours does that require to deliver, and what skill sets don't I have that I might need to bolt on? Can I bring them in as a consultant, and therefore it's more of a success-based involvement, and you can use them when you need them, and they've got other things to do whilst they're not working for you, or is it something that's big enough that you need them in-house and build that team. So, there's probably not a catch-all answer, but I'd say it's working back from your business model, your ideal business model, working back into what you need to deliver that.
Yeah, no, that's good advice. Can you give us a bit of a recap on some of what the sponsor criteria is for lenders at the moment?
Yeah, so just to look at, I guess, the 3 main elements is sponsor story, market, and project metrics. So sponsor story is all about what is their track record, have they done it before, and very importantly, have they made mistakes? If a developer says, I've never made a mistake, I've never used a cent of my contingency, it's a little bit boring. We like to hear that people have had issues, because every project seems to have some kind of obstacle that pops up from left field. So talk about
a project that doesn't have some issues, Dan.
Exactly. So we want to hear that they're human and that they had this issue arise and they didn't know how to solve it, but they still solved it and they managed to get a solution. We also look at, in the sponsor story, who have they borrowed from before and how did that go? The other one, which is critical, is do they have the financial capacity to find $500,000 if something goes wrong? What is their financial position, and how do they find a chunk of money to fix a problem if it pops up? Then the next one is market, and the most basic kind of question there is there an actual need for this product, or is it being driven by the fact that the developer saw the site for sale in the prime site section of the newspaper and they got excited and they paid the most on the day? Or are they a guru? Is their business model to be a guru in one particular geographic location and know that product inside out? They know their costs inside out, their GRs, their headworks costs. They know the plot ratios and the GFA on every site that they've looked at. Are they taking that approach to how they're going to deliver projects? The third one is just the actual project's metrics themselves. So what is the return on cost? Is there any land uplift generated because of the fact that they got the approval, or did they pay full tote on the actual development site, so they didn't have to settle it until they got all of that in a row? That's an interesting one for us to understand. Is there any unique site issues resulting in higher cost? So you might have bought the land for half of market value, but then you've got to spend more than that in civils and bulk earthworks to get it to an actual pad site that's ready for construction. So little things like that we see sometimes can really affect the approach on a project. So sponsor story, market, and then just some general project metrics that we look at. There's a lot of factors outside of that to consider, but the basic ones, sponsor, market, and project metrics, need to be very clear so that we can answer them in as few words as possible and just keep it simple, really.
Okay. And what have you learned about the market and the industry in the past 12 months?
I guess probably, that's a good question. I guess probably that there are many different ways to structure a deal. I think I've been doing this for 11 years now, and I think when it was a very bank-dominated market in terms of the way that we funded projects, we became very vanilla in the way that we funded or solved the funding solution for a developer. So it became a marketplace that was very driven by, banks were either at 75 or 80% of cost, they were either at 50 or 100% of debt cover, and the pricing was kind of the pricing. There wasn't a lot of levers or variables that you could push or pull to get a better outcome for the project. Whereas when you and at the moment we're now doing about 75 or 80% of our volume in private capital, there's a number of different ways that you can structure a deal to either start sooner, and therefore that has a better IRR for the developer, or it might be playing with MES or pref equity to get a better outcome. So I think it's probably the biggest learning for me in the past maybe 12, 18 months has just been that there's a number of different options available to fund a project, which we may have kind of previously not been as open-minded to. And when I say open-minded, I mean developers and the way that they fund their projects. So I think there's some pretty exciting stuff happening at the moment, and being involved, particularly with some of these commercial projects where we're doing things like putting investors in on a fund-through basis so that they own the asset on completion. The developer's got less than no money in the deal. Doing things where, we're involved in service stations or medical centres where we're actually putting in 100% of TDC. So the developer, again, is, involved in that project, and they've used their capital at the early phase to get it to a shovel-ready point. And then we will actually come in and 100% fund that project. That then frees the developer's cash up to go and start the next project and get that shovel ready. So being able to be a little bit more, I think the restraint of bank money has made developers open their mind a little bit to different structures. That's what I've learned.
And so just with those examples where you're providing the 100% of total development costs, would you still have the developer charging a development management fee?
Yeah, for sure. I'm definitely open to that. And depending on the size of their team or how they're actually delivering that is the approach that we'll take on what we're comfortable for them getting. So if they're a one-man band and they're charging $50,000 a month, we're not going to be that comfortable. But if it's in proportion with what they're actually doing, then that's no problem at all. They've got bills to pay, they've got staff wages to pay, they've got or a consultant that they have to pay. We're fine with that.
All right, and I think you've kind of touched on this through the points that you've raised, but which developers or what kind of developers are you seeing succeeding in the current environment?
I would definitely say that there's some successful people who have gone from building 50 apartment projects and a couple of them a year to now doing some pretty cool retail, service station, childcare, shopping centre type projects, and taking a view on them that they'll build one, keep one, and that'll then generate passive cash flow for them and again help them grow their business. And I've also seen some developers actually downsize the scale of projects they're doing like I was saying before, to adopt their business model into something that has less bottlenecks and less constraints. So that might be, they were doing a 50 apartment project and now they're doing 24 apartment because it's now 3-story walk up with no basement and it only costs them, $210,000 per product instead of doing 8 stories where it costs you $310,000 per product and takes, 15 months instead of 10 months. So things like that where people can tweak their business model a little bit to get more consistency out of their pipeline, I think is what I would consider a successful developer in the current market.
And I think you were saying that the smaller boutique projects are higher on the radar for lenders.
Well, I think they are because of, like I was saying, that they're lower risk, they're shorter time frame. You've got less exposure to cost escalation. You've got less exposure to market forces, and you're just generally in and out quicker. You'll also find, if we looked at a feasibility of a 20 apartment project versus a 200 apartment project, the developer's IRR is actually better and their risk is actually lower. But like I say, depending on what your optimum business model looks like, if you've got a certain, profitability that you want to be hitting, you might have to take a lot of 20-unit projects on board to deliver the same outcome. So it is dependent on what your approach to business is. But I see some pretty cool projects in that 15 to 25 product space. It might be land lots, townhouses or apartments, where there's some guys doing some pretty cool stuff and really growing their business with a lower risk profile than they may have previously.
Oh, well, that's good because that's where I slot right in, Dan.
Nice one.
Now, you've given us heaps of tips, but what would you say your top tip for developers out there who really want to take their business to the next level?
I think it's, sit down. What is your optimum business model? What is the size of it? How does it look? What product are you particularly passionate about? And, how are you going to reverse engineer that back into what you do in your daily business? So, if it's you want to make $3 million a year profit and, you're making 80 to 100,000 profit per product, how many products you have to deliver, how much risk you have to take, and how many projects do you need in your pipeline at any one point in time to actually deliver that outcome. So I think that's probably the takeaway I'd suggest people just sitting down, having a look at that and also doing it every year so that because businesses will change. I remember working with some businesses kind of 3 or 4 years ago, and what they're doing now is different because they've adopted their business model. So just being flexible and, being, I guess, taking a view that what works today might not work tomorrow. And so you need to adapt that. And whether that's the way you buy sites, the way you build them, the way you fund them, it's being able to adapt so that you get the outcome you want.
Very good. All right, well, let's change gears a little bit now. If you could sit down for dinner with any 3 people, alive or dead, who would they be and why?
Crikey. That is a very good question. I'll tell you what, one of them would be Simon Sinek, who's a author and kind of ideas guy.
He wrote the book Start With Why.
Correct. I guess Tim Ferriss would be another one. He's got a really interesting approach to business and business models, and good podcast guy. I listened to that for quite a while. And I'll tell you what the other one would be is a guy called Scott Pape, who's an Australian guy. I just read his book twice called The Barefoot Investor. And he just has a nice simplistic approach to finance, personal finance models. And I've given that book, I bought it 2 weeks ago when I was on holidays, and I've already read it twice, and I've already given it to a few of my mates and family members saying, you have to read this. So I reckon he'd be an interesting guy to have a chat with.
I've seen that book on the shelves at the bookstore.
Get it, read it, it's awesome.
All right, I'll definitely have to pick that up. All right, Dan. Well, thanks so much for sharing all that information with us today. If people want to find out more about Holden Capital, where should they go?
Well, definitely that product guide that we just released is a good thing to have a look through. There's a bit of education in that, and we also have a construction finance dictionary, which is available on our website, and hopefully you can make the link available just to help people better understand the terminology, and then that way they have a more educated approach to finance. So that'll be the two places.
All right, yeah, we'll definitely provide a link to that guide, and I would encourage people to go to your website, which is holdencapital.com.au. There's heaps of really terrific resources for developers, and sign up to your mailing list because you send out really good information like the guides when they become available. Yep. And of course, listen to the podcast, Constructive Finance Podcast.
Yep. Excellent. Thanks for your time, Justin.
All right, Dan. Always good to talk.
Cheers, mate.
Talk soon. There you go. Another fascinating chat with Australia's #1 commercial finance broker. I always enjoy speaking with Dan as he shares plenty of gold to help developers take their business to the next level. I'm sure you picked up lots of ideas from that conversation, as I know I did, and here's 3 things that resonated with me. 1. Have you identified your business model? Do you know what type of developing business model you have? Do you build townhouses, apartments, house and land packages? What's your profit margin per unit? How many units do you need to produce each year to generate the revenue and profit that you want? Are you looking to switch categories? These are all questions that would be good to have answers to, because once you understand what you do, you can set about on making it happen. 2. Are you harnessing the power of your capital? Making your money work harder can sound like a cliche, but in such a capital-intensive business as property developing, it pays to look at ways to recycle your money quicker and generate more returns. This may mean looking beyond traditional bank finance, looking beyond project to project, and also beyond the cheapest funding option out there. This might be a significant shift in thinking as you move from cheapest money to a model that may create a higher velocity of cash flow. 3. Be ready to change and adapt to the marketplace. The property market is always going to be dynamic. The economy will ebb and flow, sentiment will change, and regulation and policies will flex. So you can count on change. A change in the market can be an opportunity to switch product offering, move into different sectors, or perhaps a new market altogether, whether that is interstate or overseas. So give some thought to what moves you could make if things tightened up in your segment of the market. Alright, we are just about at the end of episode 35. Don't forget you can find me on Instagram and Facebook by searching for Property Developer Podcast. And remember, you can find all the past episodes of the show over at www.propertydeveloperpodcast.com. You can listen to the previous conversation I had with Dan Holden, which is episode 14. And if you want more finance tips, then tune in to episode 28 with Matthew Royal. Thanks again for listening in, and until next time, may your capital start generating some serious velocity and providing exceptional returns.
You've been listening to the Property Developer Podcast. Tune in next time for more tips, ideas and inspiration to take your developing to the next level. For more developing love, make sure to visit propertydeveloperpodcast.com.